What is a stock? It might strike the experienced investor as an overly simplistic concept, or the beginner as something too hard to understand. Well, it is actually neither. In general, there are many types of stocks and shares, but we will be looking at the type that applies to the ones in the stock market. Those stocks are basically pieces of publicly traded companies, the key word here being publicly traded. When a company is trading publicly, then anyone can buy into it and become a part owner of the company, thus becoming what we call a shareholder. On the right is a list of the largest publicly traded companies by market capitalization. As a shareholder, you are a partial owner of the underlying company and have a set of rights, which are called shareholder rights. According to Investopedia, those rights include voting power on major issues, ownership in a portion of the company, the right to transfer ownership, an entitlement to dividends, which is something we will look at in another lesson, the opportunity to inspect corporate books and records, and the right to sue for wrongful acts. Something important to note is that the larger amounts of shares a shareholder owns, the more influence he or she has within the company. So they basically have a greater say in the decision-making process. Shareholders also attend shareholder meetings where key decisions are made. Stock tickers and symbols. This picture is what a stock ticker looks like. A stock ticker is a report of the price of a certain stock. It is updated throughout the day. A change in the price is called a tick. Stock tickers also display the percentage gain of a stock. In many cases, whenever the price of a stock is up, the ticker for it will be green, and whenever a stock is down, the color will be red. Even though it rarely happens, if the price is unchanged, the ticker will be gray. A stock symbol is a unique set of letters which is assigned to a company when open on the stock market. It is used to facilitate the vast array of trade orders that pass through the stock market every day. On the bottom right-hand side is a table with some popular company symbols. As you can tell, the symbol letters chosen do not stray away too much from the actual company name. So for example, Google kept the first 4 letters, Apple added an extra A and removed a P, Yahoo removed the A, IBM conveniently chose its own letters, and Facebook just kept the F and B. An important thing to realize is that some companies open to the stock market earlier than others, so they have a greater chance of picking the letters they want. So for example, IBM opened in 1978, when there weren't as many companies as there are now. So for a company like Apple, they were forced to pick the AAPL because another company named Apple Pete Corp picked APPL before them. And this concludes the first lecture on what is the stock market. The reason why you'd invest in a stock in the first place. So, how is money made with a stock? There are actually 2 main ways this happens. The first is through what we call capital gains. This term is not only used in the stock market, but also in the bond and real estate markets. Capital gains occurs whenever the price of the underlying stock increases in value from the original purchase price. For example, say Joe buys 10 shares in Boeing, which has a current stock price of $100 a share, for a total valuation of $1,000. 1 month later, Joe checks back on his investment and sees that Boeing's stock price is at $130 a share. So Joe decides to sell his shares. Since the stock price increased $30 or 30%, he made a $300 profit from it. That $300 profit is what we would call capital gain. The same thing would occur in the opposite scenario, except we will call that capital loss because Boeing's stock price would have plummeted. Something important to note is that the gain is not realized until the stock is sold. Like everything, when you incur capital gains, you have to pay what we call capital gains tax. This tax varies from country to country. In the United States, individuals as well as corporations are subject to capital gains taxes on their annual net capital gains. And obviously, if capital loss occurs, then you are exempt from the tax. The second way of making money in the stock market is through dividends. Dividends are a little harder to understand, so we'll start from a definition. A dividend is an amount of a company's profits that the company pays to people who own stock in the company. So a dividend occurs when a company distributes a portion of its earnings. This process is decided by its board of directors. The board will always use dividend distribution in times of profit in order to attract and keep investors. It can also be interpreted as a statement which says, "We are a strong company." The dividend is often called the DPS, or dividend per share. It can also be quoted in terms of percentage, so dividend yield. In many cases, the more stable the company is, the more dividends it will offer in order to counteract its low price action movement. So basically, how much it moves up or down. On the other hand, a high growth company will rarely distribute dividends so the capital can be reinvested in the company to continue its high growth. Let's take an example. Say Joe is in search of another investment after a successful Boeing venture. A friend who is an investment banker gives him two picks, AT&T or Facebook. AT&T offers what we would call a fat 6% dividend yield, while Facebook doesn't offer anything. On the other hand, Facebook is projected to increase 30% in the coming year, while AT&T's projections say it will remain at the same price. Joe faces a tough decision. It seems as an obvious one, but when looking into it, it becomes harder. Facebook's projections say it will increase 30%, but those are only projections. Nothing is for sure. For all we know, Facebook could plummet another 30%. AT&T provides a solid 6% of the stock price as dividend. In this case, what is believed in the investment community is that an older person should invest in the more secure investments, while a younger person has the time to risk the capital and take the chance. Either way, both capital gains and dividends depend on the fortune of the company. Dividends as a result of the company's earnings, and capital gains on the investor demand for the stock. So this concludes the lecture of how money is made with the stock. A factor important to the understanding of stocks is learning how they are described. Some of the terms analyzed in this lecture will be market capitalization, industries and sectors, and cyclical and secular companies. Let's start off with market capitalization. You'll often hear companies referred to as large cap, mid cap, or small cap. All these terms refer to the overall market capitalization of a company. It is basically a measure of a company's size. In other words, it can be described as the dollar value of the company and is calculated by multiplying the number of shares outstanding by the current market price. The shares outstanding of a company can be found on any financial website, such as Yahoo or Google Finance, and is just meant to represent the company's stock held by all of its shareholders. There's no specific point in order to qualify a company as being a large cap, mid, or small cap. But usually you'll see a small cap company being valued at less than $1 billion, a mid cap company between 1 and 5 billion, and large cap over 5 billion. Let's just look at a quick example in order to illustrate the concept. I'll use Apple stock as the example. Say Apple has a stock price of $500 per share and has 900 million shares outstanding. If you were to multiply both figures, you would find out that its market capitalization stands at 450 billion, earning it a spot as a large cap company. Larger cap companies will tend to be much less vulnerable to the ups and downs of the economy, in large part due to their huge financial reserves. On the other hand, small cap companies are much more vulnerable to turmoils, but can provide for a lot more growth versus large caps. Companies are always divided into sectors and industries. A sector represents a large part of the economy. These can be sectors from financial to technology companies. Industries, on the other hand, are much more specific, and are part of a sector. For example, banks are an industry within the financial sector. The existence of sectors and industries are important to note as they frequently all move together in terms of stock price. An event in the economy can affect an entire industry. For example, if there were higher gas prices, the profits of transportation companies would fall, thus causing the company's stock price to plummet. Or if an industry was in the midst of innovation and was the center of attention. Much like during the dot-com bubble, which was a time when investors bought up any tech companies they could find, even though their stock price was worthless. This resulted in the crash of 2000. An important part of maintaining a healthy portfolio, which means a collection of stocks, is by having stocks that belong to different sectors and industries. It is important as if, say, a stock of one industry were to fall, you would have the downside protection of the other stocks, which would belong to different industries and sectors. Stocks are also divided into two very important categories, the seculars and the cyclicals. The big difference is in the way that they make their profits, therefore responding to the relative strength or weakness of the economy. Secular stocks make up stocks that people need, regardless of the state of the economy. So for example, consumer staples, which are basically supermarkets, etc., or healthcare. So basically services that people will always use even during a weak economy. The opposite to these are cyclicals, sectors and companies that require a strong economy to thrive. Industries such as travel or luxury goods are some of them. During times of economic hardship, they tend to have decreased profits as people try to cut down on unnecessary expenses. The three major descriptions of stock discussed in this lecture were market capitalization, which is the company's total value, sectors and industries, which are categories in which companies are placed in relation to what they do, and seculars and cyclicals, which is related to the two different types of companies and how they make their profits. So this concludes this lecture on how stocks are described. Thank you very much. In this lecture, we'll be looking at different types of stocks. Many of the things learned today are related to previously covered material, such as capital gains and dividends. We will also be going through common and preferred stocks, as well as their different classes. When you choose to buy a stock, you have the choice of buying two kinds of them, common or preferred. All publicly traded companies issue common stock, and some others issue preferred too. In terms of losses, you could say that preferred stock exposes you much less to the risk than common stock. On the other hand, it does give you much less potential for total return. Total return basically means the capital gains and the dividends you receive from an investment. When you hold common stock, you will most definitely feel the ups and downs of the company, as their share price would rise or fall continuously. They reflect the investor demand and the state of the markets. There are also no price ceilings, so the share price could possibly triple, but also lose that value. It is possible that the issuer of the common stock pay dividends, but it is not required to do so. And if it were to, the dividends wouldn't be guaranteed. The company could even cut or eliminate the dividends, though it would be a rare scenario, as it would send the wrong message about the company's financial health. When you're a holder of preferred stock, you're usually guaranteed a dividend payment. More importantly, the dividend is paid out before the dividends of the common stockholders. Unlike common stock, the price of preferred stock doesn't move as much though. Something interesting to look at is when a company goes bust or bankrupt. In that scenario, the priority and obligations go first to the preferred stockholder before the common stockholder. So in a very basic way, you could say that if you're in search of capital gains, then you should go for a common stock. But if you prefer dividends, then preferred stock is for you. Let's illustrate everything. So Joe is back for round 3. He's got his eye on Apple this time. He's decided whether he should buy its common stock or preferred stock. Joe's around 50, and he's looking for a stock that he can hold until he's late 80s. In this case, since he's willing to buy and hold the stock for so long, it would be recommended that he go for the common stock, as he will experience a larger gain through his capital gains. Buying preferred stock would apply more to him if he were 60 years old and he was looking to live off passive income, as we call it, which is basically dividends. There's another classification of stock. In addition to the choice of common or preferred stock, some companies may offer a choice of publicly traded share classes. These classes are designated by letters of the alphabet, usually A and B. A company may offer a class of stock which is reserved for one of its divisions, like another company it might have acquired. In another case, a company might issue different stock classes and have them trade at different prices and have different dividend policies. When a company has dual share classes, it's more common for one share class to be trading publicly while the other one is non-trading. Non-traded shares are usually kept for the company founders and management. Those shares are kept under tight restrictions from being sold, and they tend to have what is called super voting power. This way, it makes it possible for insiders to own less than half of the total company shares, yet control the outcome of issues that are put in shareholder vote. For example, a decision to sell the company. In order to recap everything, common stocks have to do more with capital gains, and because of that tend to have much more risk than their preferred counterpart. Preferred stock is more in relation with dividends and is consequently a much safer investment, but with limited upside. Stock classes are just classification of stocks and are used differently according to the company. So this concludes this lecture. I hope you enjoyed. Thank you very much. So, what makes a stock price change? The answer to this question can be as simple or as complicated as one wishes it to be. At the most basic level, stock prices move as a result of what we call market forces. Market forces is a word used to describe supply and demand. So a stock will move depending on its demand versus its supply. If more people want to buy a stock, which is the demand, than sell it, which is the supply, the price will move higher. But on the other hand, if more people want to sell a stock than buy it, there would be greater supply than demand. Consequently, the price would fall. As William O'Neill, a very famous stockbroker, said, "It takes big demand to move supply up, and the largest source of demand for stocks is by far the institutional buyer." When the major investors in the market act, they exert tremendous influence over stock prices. So those are institutions such as mutual funds, pension funds, banks, etc. They exert the force due to the sheer size of their orders on a stock. These large transactions tend to drive prices up or down depending on the degree of buying or selling. How can you tell if people are buying or selling a stock? Well, there's this metric called volume. The volume of a stock basically tells you the number of shares being traded during a period of time. Therefore, a large increase in volume percentage can indicate increasing demand from those institutional investors. This is followed by increasing share prices. Keep in mind that institutional investors aren't the only ones who can make stock prices change. Regular investors can too. It's just that it would take more investors to deploy the same amount of capital as institutional investors do. Understanding supply and demand is easy. Where it gets a little more complicated, though, is figuring out why people like or dislike a particular stock. The reason why it is so difficult to understand is because every investor has his or her own strategy, which they execute. But all in all, this comes down to figuring out what news is positive or negative for a company. The principal theory is that price movement of a stock indicates what investors feel a company is worth. If you remember from a few lectures back, that is market capitalization. To further complicate things, the stock price doesn't only reflect a company's current value, but also it reflects the growth that investors are expecting in the future. By far, though, what affects a company's value are its earnings. Publicly trading companies are required to report their earnings 4 times a year, once each quarter. Since most of those companies report them during the same time, investors call those periods earning seasons. Investors watch company earnings with a lot of attention. If a company's results are better than expected, the stock price will jump. But if a company's results disappoint, the price will sink. Obviously, earnings aren't the only way that public sentiment can change concerning a stock. A famous example is the 2000 dot-com bubble, when dozens of internet companies rose to have huge market capitalizations without making the smallest of profit. As you might already know, the valuations did not hold, and those companies saw their stock prices plunge and valuations shrink. The fact that prices moved that much shows that there are many other factors besides earning that can influence a stock. So, in conclusion, what makes a price change? Well, no one really knows for sure. Some think that it is impossible to predict how prices will change, while others use different strategies to figure the next move, which is what we will be looking at in the next lecture. The most important concepts to grasp from this video are: number one, stock prices are fundamentally driven by supply and demand, which in a way you can look at as public sentiments. Number two is that, in theory, earnings are what affect the valuation of a company, but there are other ways investors use to predict stock prices. But something important to remember is that investor sentiments and expectations are what ultimately affect a stock price. So this is the end of the lecture. Thanks for watching. In this lecture, we will be looking at the stock exchange, where nearly everything stock-related happens. I say nearly because there has recently been a huge shift to online investing without the actual use of the physical exchange. We will come to that later. We will also be looking at the different types of markets: the primary, the secondary, and the OTC, or over-the-counter markets. The stock exchange is an exchange for stockbrokers and traders to trade stocks. The function of an exchange is to ensure fair and orderly trading, as well as the dissemination of price information of any stock on the exchange. The exchange gives companies a platform to sell their stock to the investment public. In order to trade a stock, it must be listed in the exchange. There usually used to be a central location for record keeping, but it is currently becoming less linked to a physical place, as markets are now electronic networks, which gives the advantage of speed and reduced costs for transactions. The trading on the exchange only happens with members, so brokers and dealers, basically. When a company chooses to go public, they go through an IPO, which stands for Initial Public Offering. This process is done in the primary market. The primary market is the market that issues new stocks on the exchange. It is facilitated by what is called an underwriting group, which is basically an investment bank that sets a beginning price for the stock and sells it to the investors. Once the IPO is done, the actual trading of the stock happens in the secondary market, which is the stock market. In addition to the primary and secondary market, there are also the third and fourth markets. They aren't as important because they don't concern the individual investor. All they do is make market transactions between brokers and dealers, as well as large institutions, through what we call the OTC market. The OTC market is a decentralized market which means that it doesn't have a central location. The transactions occur through various communication modes, such as through the telephone or by email. OTC markets are much less transparent and are subject to fewer regulations. Let's take a look at the history of the exchange. The first real company that issued shares was the East India Company. The shares were issued on paper, so investors could then sell the paper to other investors. At that point, though, which was during the 1600s, there was no real stock exchange in existence, so investors would have to track down a broker to make a trade. In London, though, brokers and investors would meet and do business in coffee shops. The first stock exchange in London was created in 1773, 19 years before the New York Stock Exchange. At that time, though, the London Stock Exchange was forbid to deal stocks, while the New York Stock Exchange could from the very start. The New York Stock Exchange actually has a rather interesting history. It was formed by brokers that used to deal under a buttonwood tree, which was located on Wall Street. The reason why it grew to be the most powerful exchange was because of its location. It was in the heart of all business and trade coming and going from the United States, as well as the base for most banks and corporations. Back in Europe, the London Stock Exchange emerged as the leading exchange in Europe. Exchanges are located all around the globe, with some of the more famous ones being the New York Stock Exchange, the Nasdaq, and the Tokyo Stock Exchange. The New York Stock Exchange is primarily auction-based, with specialists being physically present on the exchange trading floor. Each of these specialists specializes in a particular stock, buying and selling it in the auction. There is an ongoing rivalry between the specialists and the electronic-only exchanges that claim to be more efficient because they are able to execute trades much faster by eliminating human intermediaries. The Nasdaq is another large exchange in the US. It is an electronic exchange and sometimes called screen-based because buyers and sellers are connected only by computers. To sum up everything, we looked at how exchanges work as well as their history. We also looked at the functions of the primary, secondary, and OTC markets. So, I hope you enjoyed it, and thank you for watching. As we talked about in a previous lecture, the initial public offering, or IPO, takes place in the primary market and basically occurs when a company chooses to list itself on the stock market. To become a good investor, it's necessary for us to explore how and why this takes place. Any company that is created and incorporated is initially a private company, meaning that it is completely controlled by a group of owners. The reason why it is considered private and not public is that no other owner can come in and buy stake in the company unless there is a special agreement. At the same time, no shares are traded on the stock exchange. On the other hand, a public company simply means that it trades on the exchange. So let's use Twitter as an example of an IPO. Twitter was founded in 2006 by a group of computer scientists. Over time, Twitter has become one of the largest social networks, rivaling Facebook and Instagram. After growing to over 200 million active users, the owners of the company were faced with a very tough decision: to go public or remain private. They ended up opting to go public in September of 2013 in one of the biggest IPOs on the New York Stock Exchange. There are a couple of characteristics of a public company, or a company that has chosen to list itself on the stock market. The first is that the company is listed on the stock exchange, whether it be the New York Stock Exchange, like Twitter chose to do, or the Nasdaq. Another vital characteristic is that a public company can be owned by thousands, if not millions of different people, all of whom become shareholders. This means that the previous owners lose some control of the company, since anyone, whether it be you or me, can buy shares in the company. So, What's the purpose of an IPO? Why would the owners of Twitter want anyone to become a part owner? Well, companies typically choose to go public for many reasons. Probably the most significant is to raise capital. Companies can raise tons of money if they choose to get listed on a stock exchange. Twitter itself planned to raise over $1 billion through its IPO. Businesses need to raise money if they want to expand their operations. In Twitter's case, they need data centers to ensure information from tweets gets stored. Those data centers can become very, very expensive and cost up to $50 or $100 million. So their two only options to fund that investment is to either raise debt or equity. Debt basically means taking a loan from a bank, and equity means issuing shares in the company and allowing other people to become shareholders. The advantage of equity over debt is that equity does not have to be paid back. When you get a loan, you are obliged to pay back the amount you borrowed with interest. With equity, however, someone can invest in your company and own shares, which hopefully will increase in value. People who bought shares in Twitter at the initial price of $26 made a 70% return if they held to the end of the day. So, how does this impact you? Well, as we just saw from Twitter, IPOs can sometimes present great buying opportunities. The biggest issue that an investor can face when trying to invest in an IPO is actually getting hold of shares to buy. Since it's become so competitive, priority is given to large institutional clients such as mutual funds or big investment firms. Nevertheless, depending on the broker you choose, which we will talk about in another lesson, IPOs may be available to you. Another important point to remember about public companies is that they are required by law to report all financial information, whether it be revenue, expenditures, or assets, to the public. So, if you're a prospective investor, it's your duty to take a look at these results to truly understand how a company operates and determine whether it would make a good investment. To sum things up, there are many reasons why a private company will choose to go public. Raising money is probably the most important one. When Twitter went public in 2013, the share price opened at $26 and ended the day at $44. Anyone who bought shares at 26 made over 70% in a single day. So, not only did it benefit the investors who became shareholders, but it also benefited the company, which eventually raised over $1 billion. That said, the IPO process is not all roses. There are a few issues a company has to deal with. A big one is that the owners lose some control of the company, and they become accountable to different shareholders. This is the reason why public companies are meant to report all financial results to the Securities and Exchange Commission, whose website anyone can access. So, if you're a shareholder or potential investor, it is in your benefit to check up on the results of a company to verify if it is a truly worthwhile investment. That's all for the initial public offering. In this section, we will be delving into the lives of three famous investors, all of whom shaped the world of finance and proved that it is possible to make money investing in the stock market. If we plan on becoming good investors, it's absolutely crucial we study all these men closely. The first investor we'll take a look at is Warren Buffett, who is likely the most renowned financier alive. Warren's career in the investment world has made him the second richest person alive, with a net worth of over $60 billion. Warren Buffett was born in 1930 in a place called Omaha, located in the state of Nebraska in the United States. His father was a stockbroker, and Warren has often credited his initial interest in the markets to his dad. Warren began his career in finance at an incredibly young age when he bought 3 shares of a company called City Service at the age of 11. This first move into business led him to launch a newspaper route at 13. From there, he attended the Wharton School at the University of Pennsylvania, as well as the University of Nebraska, where he obtained his undergraduate degree in business administration. Consequently, he ended up pursuing a master's in economics at the prestigious Columbia University in New York. It is there where he met the celebrated investor Benjamin Graham. Graham soon became Warren's mentor and taught him the concept of value investing, which is the investment strategy that Mr. Buffett continues to use to this day. In 1954, Graham offered Buffett a job as an analyst at his firm Graham Newman Corporation, and by 1956, Buffett was out on his own when he founded Buffett Partnership Limited, a firm that was created with $100,000 in capital reserves. A few years later, he would end up acquiring the business he is most famous for owning these days, Berkshire Hathaway. Funnily enough, at the time, Berkshire Hathaway was actually a textile business in severe financial distress. Buffett took it over and turned it completely around, making it a platform to buy other companies. This made Berkshire a holding company. Through the years, Buffett would acquire and invest in other businesses, which has led to Berkshire becoming the 8th largest company in the world. So how did Warren Buffett make such profitable investments? As mentioned earlier, Benjamin Graham taught Warren the concept of value investing, buying high-quality businesses at cheap prices, essentially betting on stocks whose intrinsic price, so whose fair value, is higher than the current market price. This, of course, is much easier said than done. Finding good investments takes a lot of time and very careful analysis. One of the traits that separates Warren from the average investor is that he is willing to ignore anything that goes on in the stock market and just focus on the business itself. Buffett believes the markets can be emotional, like a human. One day the market is up, the other day it's down. The goal is not to worry when stocks drop and not be overly happy when stocks are up. In the end, as long as the business is good, you will profit. Here are some of the traits that the companies he invests in possess. The first is great management. A company cannot perform well unless it is managed by experts who act with integrity and are honest with shareholders. In many cases, good management is what can turn a lousy business into a high-growth company. At the same time, management should be shareholder-oriented and attempt to maximize shareholder value. There are many ways a company could do so, but these mainly take place in the form of dividends or share buybacks, which is basically when a company buys back its own shares, which increases the stock price. If management is shareholder-oriented, you can rest assured that it will always do whatever it can do to actually boost the stock price. Warren looks for businesses he actually understands. He constantly talks about staying within your circle of confidence. If you do not understand what a company does and cannot speak about its operation with a certain level of confidence, you shouldn't invest in it at all. For example, Warren does not invest in technology companies as he does not profoundly understand them. The company should create a high-quality product that entices consumers to keep on purchasing. Product is key if aiming for stable and high growth. In some way, shape, or form, a business should have an advantage relative to competitors. If not, any other rival can come in and snatch up market share. Last but not least, a business should have a steady revenue stream with predictable and growing earnings. Earnings are vital if aiming for high returns. One of the topics Mr. Buffett talks about most is his admiration of companies with wide economic moats. An economic moat, which is a word invented by Warren himself, represents a factor that protects a company from competitors, whether it is a technology unique to the company, a patent, or even simply a strong brand name. One of my favorite Buffett quotes is, "In business, I look for economic castles protected by unbreachable moats." The purpose of a big moat is to really maintain demand for the business's products over a very long period of time. So, now let's take a look at some of Buffett's most profitable investments. One of Berkshire Hathaway's largest positions is in Coca-Cola, the manufacturer of the popular soft drink. The position itself is worth over $15 billion. Think about that. With so much money, you could choose between buying American Airlines or the entirety of the NBA basketball league. Buffett made his first investment in Coca-Cola in 1988, over 28 years ago. Back then, people criticized his move and said that another competitor would enter and steal Coke's market share. Well, Coke has continued to be very successful and has generated more than an 800% return for Mr. Buffett. As we talked about just before, Coca-Cola is a great example of a company with a wide economic moat. Coca-Cola's brand name is so strong that it continues to dominate the market for soft drinks. In addition, Coke is a product that Mr. Buffett can easily understand. Finding businesses whose operations you can actually comprehend helps tremendously in figuring out whether they will continue to thrive in the long run. Another one of Buffett's profitable positions is in Wells Fargo, an American financial services company. He began amassing his position in 1990 and has continued to accumulate his investment, which now stands at over $16 billion. This means he owns roughly 8.5% of the company whose market capitalization is around $200 billion. In the last 24 years in which he has owned Wells Fargo, the stock has moved up over 9,000%. Talk about a great return. Buffett initially got into the business during the savings and loan crisis, which was a financial downturn that impacted large banks around 20 years ago. As I mentioned earlier, unless a crisis has a direct impact on how a business performs, Buffett disregards the movements of the market. So while others were selling, he was buying. This is probably one of the best examples, which shows why Warren Buffett is regarded as one of the greatest investors of all time. To sum things up, it's pretty obvious to see why Warren Buffett is such a legend. His ability to focus on an underlying business instead of being caught up by all the fuss in the markets is admirable and is something that countless investors attempt to replicate. What's most fascinating about Mr. Buffett is his keenness to educate the next generation of investors. A large portion of today's most successful fund managers relies on his conception of value investing, which were initially taught to Buffett by Benjamin Graham. So, if we hope to become good investors, and maybe even one day become the next Warren Buffett, it is important for us to find high-quality businesses that trade at a lower price than their true value. Another top-notch investor who was at the same time responsible for the birth of a different form of investing is Philip Fisher, who is considered to be the father of growth investing. Fisher got his start out of Stanford Business School when he dropped out in 1928, a year before the market collapse of 1929. He launched an investment firm at the age of 24 and focused on investments in Silicon Valley companies, especially in companies that invested a lot of capital into research and development, as well as building innovative new products. In his mind, these were the types of businesses that could generate spectacular returns for a shareholder. Fisher's assessment of a business wasn't merely based on numbers and charts. He placed a great emphasis on a firm's management and ability to deal with incoming problems. He also attempted to comprehend the organizational culture of a company. Fisher was very disciplined and had developed a 15-point checklist, which he went through before making any investment. The checklist will be attached to this lecture as an article. What's interesting about Fisher is that he began his investing career as a value investor, much like Warren Buffett and Benjamin Graham. Through the years, though, he began to refine his style, especially after the stock market crash of 1929. After these events, he felt that some stocks might be incredibly cheap for a good reason, and that many of the counting tools that value investors employ do not take into account any extraordinary problems a company might have. As such, Fisher focused on any and all of a company's growth factors. So essentially, while value investing involves finding high quality companies that are undervalued by the market, growth investing takes place when betting on stocks that are in the midst of moving higher. The key difference between both is that growth investors don't mind paying a higher price for a good business. So, what did Fisher look for in a company? Well, his approach is a little tougher to describe than that of a value investor since it relies more on his personal thoughts on the future of a particular industry or technology. In general, however, there were a few factors he would pay very close attention to. The first, much like Warren Buffett, is that he would seek out firms with great management. As you can start to tell, management is vital to the success of a company. That said, unlike how a value investor might attempt to find more predictable and stable management, a growth investor will focus on how innovative management is. A good example could be Steve Jobs, who pioneered many of Apple's best-selling products, including the iPod and the iPhone. To justify high growth, management must push out and release novel products on a regular basis. In addition, as mentioned earlier, Fisher liked companies that put money towards research and development. Without investing money towards the future, how else is a company meant to perform well? Probably the key tenet of the growth investing philosophy is growth itself, especially growth in earnings. So higher earnings come about through more revenue and less costs. A company whose margins are low are especially of interest. Low margin basically means that it doesn't cost a lot to produce a product, which of course is essential for high profits. As we talked about in a previous lecture, earnings are another feature that drive stock prices up. Fisher would invest in companies that he believed could grow earnings and, most importantly, sustain that growth. Probably Fisher's most famous investment was in Motorola, a company that I am sure you must have heard of at least once in the past. Motorola was an American multinational telecommunications company that focused on producing telephones and wireless technologies. The company was recently broken up into two separate firms. The business was founded in 1928, and back then it focused mostly on creating televisions and radios. Due to its high growth, Fisher became interested and initially invested in the company in 1955, over 61 years ago. Prior and after Fisher's investment, the company grew its revenue at a stellar pace of over 68%. Motorola continued to innovate throughout the next few decades after Fisher's investment and ended up becoming one of the largest telecommunication companies in the world. If Fisher held on to the stake until the year 2000, he would have generated a 6,000% return. This points to the importance of long-term investing. This is something that Warren Buffett agrees with. Investing for the long run presents the greatest opportunities to generate high returns. Short-term investing, in other words trading, can be detrimental to an inexperienced market participant. As such, we can learn much from legends such as Philip Fisher and Warren Buffett, who were able to do so well for so long. Speaking of Warren Buffett, Buffett himself said that his investment philosophy is 15% Fisher. So, in the end, even though Philip Fisher chose to follow the route of growth investing over value investing, he became incredibly successful and has influenced countless individuals. His approach of picking great businesses with high quality management and high earnings growth is very similar to that of a value investor, even though his focus would be on growth instead of price. There's no set rule for doing well in the markets, but Fisher just proves how it doesn't really matter what strategy you follow as long as you are disciplined and look for fundamentally good businesses that will continue to thrive in the future. So, that's all for Philip Fisher. Peter Lynch is undoubtedly one of the greatest investors who's ever lived, not only for the stellar returns he produced, but also for his passion to educate others about investing. While at the helm of Fidelity's Magellan Fund, he generated a 29.2% annual return from 1977 to 1990. This record is unheard of anywhere else on Wall Street. So, let's dive into this incredibly interesting man's life and explore what led him to become such a great investor. Peter Lynch was born in 1951 in the state of Massachusetts. He attended the local Boston College as an undergraduate, which is where he discovered his interest for the markets. As a sophomore, he used his savings to buy 100 shares of Flying Tiger Airlines at $8 per share. Soon enough, the stock rose to $80, making him 10 times his money. He later attended the Wharton School to obtain an MBA. Lynch began his career at Fidelity Investments, one of the largest mutual funds in the United States. Lynch joined Fidelity Investments as an analyst, but quickly rose through the ranks to become head of the unknown Magellan Fund, which at the time had $18 million in assets. By the time Peter was done with the fund in 1990, his legendary record had attracted over $14 billion in assets, with roughly 1,000 stocks in the fund's portfolio. As outlined in his book, One Up on Wall Street, Lynch has a very specific way of analyzing stocks. You could say that he blends both value investing and growth investing into one, looking for situations in which a company can significantly outperform the market. Though he does not concern himself too much with the price of a stock, he does place a big emphasis on companies that can consistently grow. During his time at Fidelity, he was able to pick over 100 stocks that multiplied his investment by 10. Since Peter Lynch could be considered part value investor, part growth investor, all the features we looked at for Buffett and Fisher apply to him. Nevertheless, Lynch does have a unique twist in the way he looks at companies. One of the key tenets of Lynch's philosophy is investing in what you know. This is something we heard Warren Buffett say countless times, but I can't stress this enough. If you don't understand what a company is doing before investing in it, then it's like betting on the slowest horse in the race and hoping that the other horses ate bad hay. There's little point investing in Apple if all you know about it is that it produces phones and computers and you don't actually understand what impact something like Moore's Law will have on the cost of production of storage and semiconductors. These are obviously complicated questions, but crucial to answer if you really want to engage with the company and, most importantly, be able to actually understand its financial performance. So, you might ask, what are other possible investment areas if I don't truly understand what Apple does? Simple. Pick something you know. anything. It can be a supermarket chain or a multinational hotel company. As long as you understand it, you'll not only be interested in what the company is doing, but you'll read through the reports it releases with ease. Obviously, it doesn't mean that you understand it that the business itself is a good investment, but at least it will help you comprehend the financials better in order to eventually make a better financial decision. At the same time, Lynch provides another important piece of advice. He believes that everyone has knowledge that they can use to profit in the stock market, and that knowledge is all around us. For example, if you're a construction worker and you see that you're beginning to use a different type of cement because of its superior quality, you should look into the company that produces that cement, especially if this is a trend you see at all construction sites. Or if you're a student and you realize that all your friends are suddenly going and eating at Subway instead of McDonald's, that's certainly worth looking into. People do not realize this, but they are typically ground zero when it comes to new products and new offerings. You just have to keep your eyes wide open to new trends that could be sweeping the market. Jim Cramer, who was the star of the financial show Mad Money, once talked about how his daughter introduced him to the fast food business Chipotle before it became big, since all her friends were eating there. This is the type of information that can help you spot winners before they become giants. After you've found a company you believe can perform well into the future, it's necessary to look at its financial results in closer detail, especially the income statement and balance sheet. Using the Lynch methodology, you should always focus on growth expectations for a stock. You can do so using the PEG ratio, which looks at valuation in relation to the growth in earnings. Ideally, a stock will have a PEG of under 1, which indicates the stock might be undervalued. Another metric to consider is the percentage of assets in cash. Strong cash flow and conservative management of assets gives the company the opportunity to thrive regardless of the state of the market. It is at the same time positive to have low debt in relation to equity. These are all measurements you can find on a company's financial filings with the Securities and Exchange Commission, all of which is available online. And these are things we will talk about later too. Once you have determined whether the company is set to outperform over the coming years, you need to create a story for yourself. This is something that Lynch did before making an investment. Essentially, you want to prepare a 5-minute speech that you rehearse in your head, whereby you talk about the company itself, why it is a good investment, what it needs to do to continue to perform well, and where you hope it is heading. You might want to take note of the story you end up building and check up on the company every once in a while to verify it sticks to the narrative. In general, however, these are the 6 types of stories that can apply to different companies. The first are slow growers, which are companies that are expected to grow slightly faster than the gross domestic product, which is typically around 2%. These companies initially started as fast growers, but slowed down over time. For example, large car companies like Ford or General Motors were fast growers, but as they became bigger, their growth slowed down. Given their huge size, these companies typically pay large dividends. Stalwarts are companies like Coke, which see 10 to 12% annual growth in earnings. So even though they grow faster than slow growers, they are not as large. Fast growers are small, aggressive new companies that grow at 20 to 25% a year. Peter Lynch says that you need to find fast growers that have robust balance sheets with lots of assets and that make large profits. So cyclicals go up and down depending on the economic condition. Automobile manufacturers and airlines are good examples of these. If the economy is thriving, people spend more money on travel and buying new cars. This differs from stalwarts like Coke. If you make less money, one of the first expenses you'll cut is travel and leisure. Turnarounds, on the other hand, are companies that have recently performed poorly but are starting to pick up. Although they are hard to find, they can present great buying opportunities. Finally, asset plays are businesses that are valuable mainly because of all the assets they own. The most typical example of these are real estate companies. You need to keep in mind that a proper investment portfolio should try to mix things up and have a bit of each. Alright, now let's take a look at some of Peter's most famous investments. The first has to be Ford. Ford is undeniably one of the most renowned companies in the world, and certainly one of the best run. Lynch invested in Ford when the stock traded at $1 and saw it surge to over $14 during his lifetime. That's a 1,300% return. Another famous investment of his was Philip Morris, which at the time was the largest tobacco company in the United States. Following studies that showed smoking can kill, Philip Morris began diversifying its holdings and eventually became a major company in the food business. This led to its stock growing at an annualized 18% between 1970 and 2000. In the end, what's interesting about Peter Lynch's investment philosophy is really how it combines different strategies and adds its own twist. Lynch wants investors to really understand what they invest in, which is one of the reasons why he encourages people to invest in what they know. At the same time, he seeks to empower prospective shareholders by enticing them to keep their eyes open for possible investment opportunities that might be anywhere around them. You can't forget, a share is a piece of a company after all, so buying into a business when they really take off can present tremendous opportunities, as was proven by Lynch himself. So, this concludes the lectures on legendary investors and how they became successful. At the basis of investing is having the ability to read through a company's financial reports. I'll be honest with you and say that you'll probably not find this part too interesting, but it actually turns out this is probably the most important lecture. Knowing the ins and outs of financial statements is actually what distinguishes a great investors from mediocre ones. I'll try to simplify things and leave out some of the more complicated terminology throughout this lecture. So, let's dive in. As we talked about in the IPO lesson, every public company is required by law to report and disclose its financial information to the public. In the United States, all the information is available on the Securities and Exchange Commission's website. The Securities and Exchange Commission, or SEC, is the main organization charged with regulating the financial markets. They're kind of like a financial police, and they aim to make investing as fair as possible. As you can guess, to make informed investment decisions, you'll ideally need to go through the material a company publishes to really get a grasp of what it does and how it performs financially. Financial reports might seem incredibly complicated, but it turns out they are relatively simple if you understand their overall structure and some of the more complicated words they use. The important thing for you to remember is that every financial filing is split into three key sections: the balance sheet, the income statement, and the cash flow statement. So, let's start with a balance sheet. This basically consists of assets and liabilities and applies to companies as much as they apply to us personally. Anything that has value is an asset, whether it's a computer, a house, clothes, or a book. Liability, on the other hand, is a debt or obligation. This can include your credit card bills or student loan debts. When you subtract liabilities from assets, you will get your personal net worth, which are the net assets. Your personal net worth is just as important as the net worth of a company. However, investors typically never refer to a company's assets minus liabilities as net worth, and they instead use a fancy word called shareholders' equity. A balance sheet is important for many reasons. It can give an investor an easy look at how a company manages its finances. To illustrate the example, let's look at a company called Banana Motors Production, run by a CEO named Steve. Banana Motors is a startup automobile manufacturer. To better understand the situation, let's dig into the details of Banana Motors' balance sheet, starting with its assets. Something you'll notice in every financial statement for any company is how there are two columns with figures, in this case 2015 and 2014. This is mainly done by the company to help investors look at how a firm progresses over time and year by year. Assets are split into three main categories: current assets, other assets, and property. All these add up to the total assets. Current assets are anything that are valuable and can be converted to cash quickly and within 1 year. Obviously, cash is the most important current asset, but there are also other things like marketable securities, which can be shares the company owns that can be sold immediately for cash, as well as inventories. So, the two cars Steve built. Adding them up would give you $500,000, Banana Motors' total assets for 2015. When comparing the company's performance to the previous year, you'll notice that its assets have shrunk year by year. To find out why, look no further than the inventories, where you'll see that the value has fallen from $300,000 to $200,000. From that, we can figure out that Steve sold one of his cars for $100,000. At the same time, we see that cash has gone up by $50,000. So we can tell that Steve kept half of what he made from the sale of the car and spent the other half. Now, let's take a look at the company's liabilities. Liabilities are split under three key sections: current liabilities, long-term liabilities, and deferred income taxes. Current liabilities are the same as current assets, except while current assets provide value within a year, current liabilities are obligations that have to be paid within a year. So while one adds, the other subtracts. Current assets are made up of accounts payable, which are things Banana Motors still has to pay for, like tires that are used for the car, payroll, which is the salary Steve pays his employees, as well as taxes, which are pretty self-explanatory. Total liabilities have increased by $5,000 due to a rise in short-term expenses. So, why are large liabilities bad for a company? Well, in Banana Motors' case, the firm is very limited in what it can and can't do. It's like if you personally took a loan to buy a house, so a mortgage. If you had to make consistent payments back to the bank, you wouldn't have the freedom to, for example, switch to a nicer but less safe job. A lot of debt restricts people and companies alike and prevents them from expanding, not to mention that too much debt decreases profits. The last part of a balance sheet is actually shareholders' equity, but through our discussion we will cover this. Alright, let's review Banana Motors' balance sheet. As assets have gone down, liabilities have moved slightly higher year over year, which is negative for the business. That said, given how large assets are relative to liabilities, it shouldn't be anything to worry about in the short term. As long as Steve is able to keep up production, he should continue to thrive. Let's move on to the next section. The income statement is the second part of a financial filing and contains two key metrics for an investor: revenues and expenses. While the balance sheet is a measure of the company's overall strength, the income statement gives an investor a better understanding of how the company is receiving and spending the money it has. The revenues of a business are what it takes in, and the expenditures are what it takes out, so costs. If you want to figure out whether the company can grow in the future, this is where you'll get that information. The income statement also indicates one of the most important measures for an investor: earnings. As we have already talked about several times, at the end of the day, it's all about earnings, and especially earnings growth. A stock cannot advance without the underlying business earning more money. In the income statement, earnings are listed as net income. To illustrate the income statement, let's use a pizza restaurant chain called Pizzaland. Please do keep in mind, however, that each of the three parts of the financial statement is interrelated. The revenue part is pretty simple. The company generated $500,000 through its stores, which is $100,000 more than the year prior. Expenses are listed as operating costs and expenses and comprise of restaurant-related expenses as well as general and selling expenses. As we can directly see, there has been an increase of $100,000 between 2014 and 2015, meaning that as revenue moves up, so do expenses. This is certainly not a positive thing, but is what happens to many businesses. In this case, we see most of the money is going towards employee payments, or payroll. A solution to this is to pay employees a constant amount. Last but not least, there's income. As you can see, there's a difference between operating income and net income. Amongst other things, net income takes into account the taxes a business pays. In this case, Pizza Land pays 50% in combined taxes and interest, which leaves it with $50,000 in net income. The real negative about Pizza Land's financial position is really that it is seeing no growth in net income. Someone like Warren Buffett or Peter Lynch would want to invest in a stable company that increases its profits over time. In this case, it's not happening. At the same time, if the management of the company can solve the issues of increasing labor costs, then net income will increase significantly. Only then would it prove to be a solid investment. The last part of a financial statement is the cash flow statement, and it is split into three main parts: cash flow from operating activities, investing activities, and financing activities. Overall, cash from operating activities is what is taken in, and cash from investing and financing is what is taken out. Let's take a look at the cash flow statements using another company called Blueberry Computers, which is a computer manufacturer. First off is the cash from operating activities. At the top we see net income, followed by the two main categories of cash provided by operations: charges and credits, and changes in working capital. Charges and credits includes things like depreciation, which is how the value of an asset decreases. Companies can write off a portion of that decline for tax purposes, which in turn increases their net income. Next are the changes in working capital. Accounts receivables are what the company is owed, and accounts payable are what the company still owes. Here we can see that cash decreases since someone owes $50,000 to Blueberry Computers. Something really important to note is that in accounting, whenever a negative number is expressed, we always use brackets, so the 50,000 is in fact negative. As we said earlier, cash flow from investing typically takes out money from a business, which is why the figures are negative. Capital expenditures refers to investments made on machinery for the business, in this case automatic assembly lines to produce the computers. Investing is essential to keep a business up to date. Finally, cash flow from financing refers to how a business actually finances or funds its activities. As we looked at in the lecture on IPOs, businesses raise capital either by issuing debt or by issuing shares. Overall, Blueberry has seen an increase of 30,000 in cash outflows from financing from 2014. Overall, Blueberry Computers' cash flow statement proves that the business is stable and running smoothly. Though net income is staying flat, the business is investing more money for future growth, which is surely positive. Certainly, we would need to look at Blueberry's balance sheet and income statement to determine its worthiness as an investment, but based solely on its cash flow, you could expect that it would pay a large dividend, but wouldn't see much growth in share price. To sum things up, the balance sheet, income statement, and cash flow statement are all incredibly important and show different parts of a business's financials. While the balance sheet showcases what a business has through its assets and liabilities, the income statement focuses on how it spends its money through revenues and expenses. Finally, the cash flow statement shows how money moves in and out of the business. The ideal company would support many financial features, including high net income growth, a high level of assets relative to liabilities, as well as a high degree of cash inflows. In the end, these are the types of businesses worth looking into as an investor. In trading and investing, there are many different types of strategies that market participants employ. In this lecture, we will be looking at some of the larger and most important types. The two main types of investing are fundamental and technical analysis. We'll be starting off with fundamental. Fundamental analysis is extremely broad. You could say that fundamental analysis is the cornerstone of investing. The biggest part of fundamental analysis involves delving into company financial statements and looking at different aspects of a company, such as the revenue, assets, expenses, liabilities, etc. This is most definitely geared towards the mathematical side of trading. It involves a wide range of calculations to figure out stock prices in the future. According to Investopedia, fundamental analysis is a technique that attempts to determine a security's value by focusing on underlying factors that affect a company's actual business and its future prospects. Fundamental analysis can be performed on industries or the economy as a whole. So, as opposed to technical analysis, which we will be looking at after, which involves analyzing based on price movements, fundamental analysis goes beyond that and looks at the overall well-being of a company. Some questions a fundamental analyst might ask are: is the company's revenue growing? Is it making profit? Is it able to repay its debt? How does it compare to industry competitors? There are some of the few, but basically you would look at whether the company's stock is a good investment. So, the intrinsic value. Fundamental analysis is based on the concept that the price of a stock does not fully reflect its real value. In the financial world, that real value is called the intrinsic value. So let's take a small example. Say Microsoft is trading at $28 per share. After much analysis, you figure out that its intrinsic value, how much it's really worth, stands at $34 per share. That is 21% higher than its current value. In the eyes of a fundamental analyst, that would present a great buying opportunity, as the stock would be what we would call undervalued. In the opposite case, where the current price is $34, while you find out that it's actually worth $28, you would say that it's overvalued. The largest assumption in fundamental analysis is that in the long run, the stock will always reflect the fundamentals. But no one really knows how long the long run is. It could be a period of days or even years. So that is what fundamental analysis is really about. By focusing on a company or the economy, an investor can determine its intrinsic value and find opportunities to buy or sell. If all goes as planned, the investment should pay off over time as the market catches up to the fundamentals. On the other side of fundamental analysis is technical analysis. Unlike fundamental analysis, technical analysts, or technicians as we would call them, don't care about the value of the company, or the company as a whole. All they really care about is the price movement in the market. They employ lots of fancy and exotic tools to study the supply and demand in a market in order to attempt to determine the direction or trend in the future. Another way of describing them is that they try to understand the emotions of the market by studying the market itself, as opposed to its components, like fundamental analysts do. Technicians evaluate stocks by analyzing the statistics generated by market activity, such as prices and volume. They do not attempt to measure the intrinsic value, but instead use charts and tools to figure out the pattern. Technical analysis is based on three assumptions. Number one, the market discounts everything. Number two, price moves in trends. And number three, history tends to repeat itself. Technical analysts only consider price movements and ignore the fundamental factors of a company. The reason for this is that technicians assume that at any given time, a stock's price reflects everything that has or could affect the company, including the fundamental factors. They believe that the company's fundamentals, as well as market psychology, are priced into the stock. Therefore, there's no need to analyze the company itself. In technical analysis, stock price movements are said to move in trends. That means that when a trend has been located, the future price will move in the same direction as the trend. The last important idea of technical analysis is that history repeats itself. The repetitivity is due to market psychology. Market participants tend to provide a consistent reaction to similar market activities. Technicians use chart patterns to analyze market movements and understand trends. Technical versus fundamental analysis. In a way, you could say that it's like comparing financial statements versus charts. A fundamental analyst tries to determine the intrinsic value of a company by looking at its statements and determining whether it is over or undervalued. Technicians believe analyzing a company's financial statements is redundant, as it is all accounted for in the stock price. Therefore, they place the efficient market hypothesis at the top of their beliefs. Usually, fundamental analysis is used when you're looking towards the long term in a stock, while technical analysis is used for short-term trading. Even though they might seem contrary to each other, they can still both coexist. It can actually give the trader investor a higher chance of success, as he or she can analyze both the long and short term of a stock. So, this concludes this lecture. Thank you for watching. At the end of the day, making money in the stock market depends entirely on your investment strategy. By now, we have looked at some of the greatest investors of all time and how they were able to generate high returns. And we've also had the opportunity to explore financial statements and discuss why they are important. Now, we're going to tie everything in by looking at one of the most popular ways of investing, value investing. As we talked about with Buffett, value investing involves looking for undervalued stocks whose prices are cheap relative to what they are actually worth. The most important tool a value investor can have is time. If you don't invest time and effort into looking for companies, you won't reap the benefits. Here's Warren Buffett speaking to a group of Columbia Business School students and talking about the importance of investing time to do your research.
Hi, I'm Brian Diefenbacher. I'm a second-year student. Mr. Buffett, it's great to see you again. I was on the trip to Omaha last month. Thank you for hosting us. My question is, how would you recommend an individual investor who follows the Graham and Dodd philosophy to allocate their capital today?
Well, it depends whether they're going to be an active investor. Graham distinguished between the defensive and the enterprising investor. If you're going to spend a lot of time on investment, I just advise looking at as many things as possible, and you will find some bargains. And when you find them, you have to act. It hasn't changed at all since I was here in 1951, and it won't change the rest of my life. So you start turning pages. When I got out of school, I turned every page in Moody's 10,000 some pages twice, looking for companies, and you have to find them yourself. The world isn't going to tell you about great deals. You have to find them yourself, and that takes a fair amount of time. So if you're not going to do that, if you're just going to be a passive investor, then I just advise an index fund bought consistently over a long period of time. The one thing I will tell you is that the worst investment you can have is cash. Everybody's talking about cash being king and all that sort of thing, but most of you don't look like you're overburdened with cash anyway. So, but cash is going to become worth less over time, but good businesses are going to become worth more over time, and you don't want to pay too much for them, so you have to have some discipline about what you pay. But the thing to do is find a good business and stick with it.
Does that mean you think that we are through the roughest times? You'd always kept a cash hoard around, too.
Well, we always keep enough cash around so I feel very comfortable and don't worry about sleeping at night. But it's not because I like cash as an investment. Cash is a bad investment over time. But you always want to have enough so that nobody else can determine your future, essentially. The financial panic is behind us. The economic spillout, which came to some extent from that financial panic, it's still with us. It will end. I don't know whether it'll end tomorrow or next week or next month or maybe a year, but it won't go on forever. And to sit around and try and pick the bottom, people were trying to do that last March, and the bottom hadn't come in unemployment, the bottom hadn't come in business, but the bottom had come in stocks. So don't pass up something that's attractive today because you hope you're going to find something way more attractive tomorrow.
Let's recap what Buffett and other value investors look for. The first trait is that the company should be simple and easy to understand. We've talked about this many times, but it's something you can't forget if you plan on doing well. A good example of this is that Warren Buffett himself actually missed out on the tech bubble of 2000, as he didn't understand what most of those companies were doing. As you probably know, by 2001, most of those tech companies lost over 70% of their share prices, while others even went bankrupt. The second trait is that you should look for companies with a strong brand image. Businesses like Coca-Cola or McDonald's are known across the world and have a stable customer base. These are the types of companies that are deemed safer than the average and that can present tremendous value. Next is to look at earnings. Again, Coke and McDonald's have seen increasing earnings over a long period of time, which is what fueled their stock prices to move higher. Last but not least is management. The reason why management is so important is that whoever leads the company also determines how it will perform financially. A good CEO can make a business prosper during an entire lifetime and can even rescue a company during tougher times. Just remember, when you invest in a business, you're also investing in the management team. Alright, so how do you determine whether a company is overvalued or undervalued? There are two main ways to do this, either by relative or absolute valuation. For the purposes of this video, we will focus on relative valuation. Basically, relative value involves comparing a company to its competitors in the same industry, and we do this using ratios. There are many metrics you can apply, but one of the most important ones is the price to earnings ratio, or PE ratio. You get the figure by dividing price by earnings. The rule of thumb is that the higher the PE ratio compared to the competitors in the industry, the more overvalued the stock is, while the lower the ratio, the more undervalued it is. Let's say Apple is trading at a PE of 20, which we can get by dividing the stock price of 200 by the earnings of $10 per share. On its own, we can't really understand its value, but if we compare it to Microsoft, whose PE is 25, we can determine that Apple is undervalued relative to its peer. Another important metric is the price to book ratio. In general, book value is a rough estimate of how much a company is worth. The abbreviation for this is PB and is calculated by dividing price over book value. If Apple's PB is 14 and Microsoft's is 16, Apple is undervalued in terms of book value relative to Microsoft. Finally, the last crucial metric that I like to look at is the debt to equity ratio. As we saw from some of the legendary investors, they warn against investing in companies that carry too much debt, so businesses that have taken out lots of loans. The debt to equity ratio looks at the amount of debt in relation to a company's shareholders' equity, which, if you remember, is calculated by subtracting liabilities from assets, and is the net worth of a company. The lower the ratio, the better. If Apple has a debt to equity ratio of 0.31 and Microsoft is at 0.33, then Apple is more attractive as it carries less debt. Now, let's look at another way of figuring out value. This one's a little bit more tricky and can be incredibly complex, so I'll simplify it as much as possible. Remember how we talked about the intrinsic value of a stock? If you don't remember, the intrinsic value is the true value of a stock, and value investors try to buy when the current market price is below the intrinsic price. Right now, we'll try to figure out a form of intrinsic price for Apple using random numbers. Let's say Apple sells 100 million products per year at an average price of $1,000 each, making $100 billion in sales. To make those 100 million products, they have to spend $800, which are the costs. This means they are personally making $200 per device, so $20 billion. Obviously, Apple is a business, and businesses want to grow. Let's say that Apple sells 5% additional product each year at the price of $1,000. So next year they make $22 billion, and the year after that they make $24.2 billion. For the next 39 to 40 years, we predict they will make $337.5 billion, which we get by adding up all those figures. If you divide that by the total number of shares, we get a value of $55 per share. That is the intrinsic price. If we were to say the current market price is $40, that represents upside of 37.5%. This means that Apple is undervalued. As you can see, the most important factor for a business is growth, and growth in earnings. If a business can consistently grow its profits, higher stock prices will follow. That's pretty much it for value investing. If you're just starting out, I advise you focus on relative valuation and figuring out how a company compares to competitors in the industry. It's not only an easy way of valuing a business, but it can give you a very precise indication of what investors are willing to pay for peers in the industry. Absolute valuation and figuring out an intrinsic price is also very useful, but at the same time much more complex, and requires you to forecast free cash flow and determine things like the weighted average cost of capital. These are things that you will learn with time and as you look at more companies. In the end, as Warren Buffett himself said, only by investing time in your research will you be able to do well as an investor.